My name is Kully Samra. I represent Charles Schwab. Charles Schwab, for those of you who may not know, is the US's largest broker as it stands today in the retail space. We have about $2.6 trillion in client assets and about 9 million client accounts. We have about 350 branches across the states. Here we have an office as well, and it's my pleasure to lead that office. And my main remit here in the UK is to help investors such as yourself looking to invest directly in US markets. And really what I wanted to do today was cover three things really. The first one, based on the fact that we've just had President, or he is still here, President Obama over here, talking about the special relationship, more from a political and social standpoint, I thought we could look at the special relationship from a financial standpoint as well, because believe it or not, it still does exist between the US and the UK. And then I wanted to talk about something we've been talking to our clients about a lot, really the volatility that we've had at the moment, and just reminding some very simple lessons that we should really keep in mind, because that's one of the things that volatility does. It kind of makes us forget all of the things we've learned over time, and sometimes we have some knee-jerk reactions trying to deal with this volatility that we've had. And then really wanted to talk about Schwab's view on the US market. As a broker, we take a lot of responsibility in helping our clients find the right stocks, the right sectors, and really project a macro standpoint as well. So I'll try and talk about that a little bit as well. And of course, answer any questions. You can stop me at any time if you have a question. Please do let me know. The other thing I would point out is some of these slides have more information than I'm going to cover today. So if you need the slides, my email address will be on at the end. So please send me an email, and I'm very happy to share these slides with you. I want to start with a day in the life of the average UK citizen. This is Philip Neath, and he wakes up in the morning and turns off the alarm on his phone and jumps in the shower to wash his hair, runs downstairs and has a big bowl of cornflakes before he jumps in his car and drives to work, but on the way he stops and grabs a coffee. After grabbing his coffee, he gets to his desk, turns on his computer, logs into the operating system, and throughout the day, he works in marketing, so throughout the day he's conducting various searches online. Then it comes to lunchtime, and he's got a little daughter, and he decides to buy her a gift. He wants to buy her an Elsa doll from the Frozen movie. He goes online to find it and uses his credit card very securely to purchase that toy. And he then goes out and grabs lunch after he's bought the toy for his daughter. And then it comes to the end of his day, he puts on his trainers, decides to leave his car at work and run home. On his way home, he stops off at his favorite restaurant and buys some burger and chips. Then eventually when he gets home, has a shower, slumps on the sofa with his daughter after giving her the gift, and they stream the movie Frozen online through Netflix. Does anybody know what the connection is with all these companies that this individual has had interactions with? I'm sorry?
All American.
They're all American, that's right. They're all American listed firms. So while this is a bit of an extreme case, I'm sure some of us have consumed some of these products and services either today or over the course of the week. And through raising your hands, who consumes any of the products and services we've talked about today? Most people. Who owns any of the stocks that I mentioned just now? One hand, two, three. All the companies. Wow, that's a good investment portfolio, sir. Who owns any US stocks at all? A couple of hands there as well. So the US makes a lot of sense to own. It's 50% of global market capitalization. In fact, if you add the market cap of the NYSE and the NASDAQ together, it's bigger than the next 5 stock markets combined. And in that 5, you've got Japan, you've got London, you've got China, and some very large stock markets, but the US is still very, very large. With that size comes liquidity, comes choice, sometimes overwhelming choice, and it's my team's and my job to try and help you with that choice. We provide a lot of research to our clients, both at the stock level and the sector level. Schwab actually covers 3,000 stocks, which is the biggest coverage on Wall Street today, and we're very consistent with those ratings. We also have various analysts that come over and speak to our clients regularly, and it's my job as well to speak to our clients regularly. So I talked about the special relationship one way, but another way to talk about it is that 20% of all US stocks are actually held overseas. And of that 20%, the UK is the 3rd largest holder of US equities behind Canada and the Cayman Islands, strangely. This is data from the US Treasury. Cayman Islands holds 12.3%. You can imagine it's through various vehicles. Canada holds 12.1%, which you'd expect, being the neighbour just over the way there. And the UK holds 11.5% of that 20%. So there is this special relationship that exists. Clearly, some of you contribute towards that. And here we're just talking about stocks. We're not talking about fixed income or anything else. So there is a large cadre of clients that hold US stocks already in this country. And as I say, it's our job to help clients find those good ideas over there at Schwab. So as I mentioned, we've had a lot of volatility. We sold off just in February, something like 10.5%. The US has bounced back. We're up about 13%, I think, as of yesterday. So I want to talk about key considerations as an investor in this times of volatility. It's the simple stuff, and that's how we try and keep it relatively simple. What we've got here is diversification is very, very important. And this is a slide we show over and over to our clients. I mean, I still have clients or new clients that call us and say, I want to spend $100,000 and I just want to buy Apple. That's all I want. Apple report earnings, obviously, this week. Facebook report earnings. It's going to be a very busy week this week. We've got Q1 GDP due out as well. We have the Fed meeting as well on Wednesday concluding. Wednesday will also be when this bull market becomes the second longest bull market in history. The first longest was this one here, or at least just before there, when we saw the tech wreck. What we wanted to show here was diversification. There are two portfolios we have here. The first portfolio, the green line, is an all-stock portfolio. We've used the S&P 500 as the diversification tool in this case. Nice and simple. The blue line is a blended portfolio of 60% stocks and 40% bonds. The bonds we've used is a Barclays ETF, which is a diversified bond portfolio. And what we're trying to show is that if you'd invested $100,000 in 1999, where you'd end up today, and the ride that you would have along the way. And what we're showing is that when we saw the first bear market on this chart, we had a 45% drop if you just held stocks. Of course, if you held technology stocks like I did, I held a bunch of technology stocks in those days, you would have lost a lot more, and it felt really, really painful. However, if you had this diversified portfolio, very simply diversified, you'd be down just 21%. Fast forward to the most recent bear market we had, labeled there the Great Recession. Certainly in the finance industry, we felt the world was going to end. What I would like to point out is Charles Schwab was actually the largest US public financial services firm, listed public financial services firm, not to take a bailout or TARP from the government. We're a very well-run, responsible firm. We're very focused on serving individual investors, and that meant we hadn't gotten involved in all the subprime crisis or any of the other derivatives that we saw that were the reason for the sell-off. So it's a great firm to invest with. So you would have lost 51% if you had just invested in stocks, as I say, in this case, the S&P 500. However, a diversified portfolio means you would have lost around about 31% that time. Fast forward to the end of the year, you can see we had a dip last year. We had another dip this year, which I'll talk about more in a little while. But you would end up with just a stock portfolio at about 189,000. And clearly you can see, if you'd had a diversified portfolio, well over $200,000 is where you'd end up. So diversification is key, and that's something we have to keep repeating to our clients over and over again, especially when you see deep sell-offs, as we've just seen recently. But what we're trying to show here, we call this the quilt, and we show our clients this regularly. And what we're showing here are all the different sectors that outperform and where they all come in terms of a roll call. And what you can see is there are generally different colors that appear at the top. Sometimes the color at the top, the next year becomes the color at the bottom. It really is quite difficult on a year-over-year basis to find the hot sector. So what we're talking about here is finding these sectors instead, the ones that just revolve, the slightly orange color. What we've got there is a further moderately diversified portfolio. And this time what we've done is we've used US large cap stocks, we've used US stocks, we've used bonds, international markets as well. And the key thing I want to make sure you go away with from this is that with a moderately diversified portfolio, you'll end up somewhere in the middle. You won't lose your shirt, you won't get that home run every year, but generally you'll do okay. Overall, the annual return over this period for a diversified portfolio is about 5.8% on this chart. So about upper single digits is where you'd aim to get to. Then what we also want to show is, so this is just for a year, so one calendar year from April 15 to March 16. And again, you can see every month it's a different asset class coming out on top. But again, the moderately diversified portfolio, which you just saw revolve there, is somewhere in the middle again. So This is what we do for our clients. We help them build these portfolios. We listen to their risk profiles, how quickly they need the money, and help them construct the right portfolio for that person at that time. And that is really what myself and my team do all day long. Something else that's very important, and what concerns me about some of the sell-offs we've had lately, is that a lot of my clients who are long-term investors have almost been forced to become traders because they have been so concerned about these deep sell-offs. And it's really hard to try and time the market, as we know, and I'll go on to how difficult it is in just a second. What we're showing here is that lengthening the holding period may reduce downside risk. First, on the left here, you can see that if you hold stocks just for 1 year, you may make up to 54%, but you could lose up to 43.3%. Now, you may have all heard that you feel the pain of a loss 3 times as much as you feel the pleasure of a gain. So it really hurts when you lose money in your portfolio. I've got one gentleman nodding there. It is really difficult. However, if you hold on to, again, the diversified portfolio, in this case, the S&P 500, if you hold on to, for a 20-year period, you'll lose no money. You gain about 3.1%, and you could gain up to 17.9%. So it really is important to make sure that you hold on to your portfolio for a period of time. The other thing I wanted to show is that time in the market is more important than timing the market. So we have a period here of about roughly 5,000 trading days from 1996 to about 2015. And what we're trying to show is that if over that period you did nothing, you just held on to this S&P 500 ETF, for example, or however you might diversify your portfolio, you would make about 8.2%. Now imagine that over those roughly 5,000 trading days, you missed just 10 of the top 10 days in the S&P 500. Your portfolio will be up just 4.5%. And then go all the way to the right there, excluding the top 40 days over 5,000 trading days, you could lose 2%. And so we're showing that it's good just to stay in the market sometimes, especially when we have this degree of volatility. So this is a slide that my trading team, we have trading and investment teams within Schwab, but for those of you that may be traders, there's some very simple and very clear reminders that we try and use all the time. Diversification and a proper asset allocation plan are critical to success. Your asset allocation plan is going to be different to your needs, whether it's retirement or whether it's having children or buying a home, and your financial services provider should be helping you create that plan. Don't trade unfamiliar products or strategies. There is a place sometimes for some unfamiliar products. We had a lot of questions around these triply leveraged ETFs. Some of the big banks were issuing those. But what clients hadn't realized is that they don't perfectly track the different markets on the way down. So you have to be very careful about unfamiliar products. Set realistic profit goals. As you saw slides a couple of slides back, a diversified portfolio has been up about 5.8% over the period that we talked about. So upper single digits is probably where we'd be looking to gain. Use limit orders, not market orders. Don't get sentimental about positions. It's very easy to explain why Apple sold off because you're expecting it to come back. It's very easy to explain why Facebook sold off because it'll come back. But don't get sentimental about the stocks that you hold. Use extra caution when trading on margin, when leveraging your portfolio. Obviously, it can amplify your gains, but it also amplifies your losses as well. A lot of our clients, we encourage them to create multiple portfolios, whether they want active trading or whether they want long-term investment. It's good to keep them a little bit separate. And then use ETFs for portfolio diversification. The US is the world's largest ETF market. Schwab, as a firm, in fact, creates and sells ETFs to our clients. And ETFs that we manufacture are actually free for our clients to trade. Other ETFs, if you trade them through Schwab, any stocks for that matter, if you want to trade them with Schwab, are less than $9 a trade. So we represent one of the best values out there. Sometimes in uncertain markets, sitting on the sidelines is not a bad idea. As we've seen already, the most recent sell-off we had in the States, we were down about 10.5% up until February 11. We've bounced back on the S&P 500 about 14%. Oil, believe it or not, is up 60% since its low in February. So sometimes it's better just to sit tight. Sometimes hedging positions, closing out non-core holdings, maintaining a higher level of cash. Again, that's something we help our clients do. Hedging positions, hedging currency positions is something we try and help with as well. All bull markets and bear markets eventually come to an end. Eventually. We've seen a couple of bull and bear markets come to an end. It does happen, I promise you. Sometimes the best trade is no trade at all. Sit tight. So I want to move on to Schwab's view on the US. As I mentioned, we do have a perspective on markets. We do give guidance to our clients. And I'm just going to skip this slide and go on to our perspective on 2016. So the US economy, it's a bit of a mixed picture at the moment. I would argue it's been pretty strong, especially when you look at it compared to other stock markets and other economies as well. In fact, the IMF pegs the US as the best growing economy in the developed world. And the UK is not far behind, but of course, in the UK, we have this little election coming up in June, which is obviously going to create a little bit of uncertainty. So the stock market has forecast 9 of the last 5 recessions. That's a quote from Paul Samuelson. What I'm trying to show there is that back in February when we had the sell-off, the number one question I was getting from clients and reporters alike is there a recession on the horizon? Our belief at that time was there was no recession on the horizon. There are various indicators you can use, and I'll show you one in a second. And we still hold that belief as well. It's not that there's zero chance of recession. There is always the possibility of one, but you've got housing being pretty strong. We had existing home sales numbers this week, which were good. Building permits haven't been so strong, but that's improving gradually. Unemployment is the key factor here. As you know, 67% of the US economy is made up of the consumer. At the end of the day, what it boils down to is what kind of health is the consumer in? Now, some of the consumer confidence numbers we've had have been a little bit disappointing, but spending is picking up from the consumer. And that's primarily being driven by their wealth growing. And the wealth is growing because house prices are improving and the stock market is improving as well. But what I really wanted to talk about was an indicator that we look at, which is the leading economic indicator indices, and that's showing minor stresses. And I'll talk about a couple of other points as well. So if there's one thing you go away with from this talk, it's really this. There are various different indicators we talk about internally when we have our research meetings, whether it's the yield curve, whether it's what unemployment is doing, weekly initial jobless claims, whatever they might be doing. But I think there's one that you can really use and focus on that is really a good way to suggest if there's a recession on the horizon. The blue line here is what the LEIs, or the leading economic indicators, is reading. And you can see that the grey lines that we have there are US recessions. And then what we have, the dotted line, is where the next high of the leading indicator has been taken out. I won't go through all of it. As I say, I can email you this slide, and you can read about it more, and I can also speak to you individually as well. But the key thing I want to show you is that the leading indicators generally turn down going into a recession. The key term here is leading. And then generally what you'll see, the leading indicators will turn up just as we come to the end of the recession. So I think this is a really good indicator to focus on. Then what you've got at the bottom here are the 10 different components within that index. Then what you've got here is, using a traffic light system, is how those leading indicators are doing. Green being good, red being not so good, and orange okay. As you can see on the left-hand side there, on the right-hand side rather, is what the trend is. And that's the key thing you want to focus on. What is the trend of the different sub-indicators? The only ones that are red are building permits and consumer expectations for business conditions. Now, building permits, it's a bit of an anomaly because the housing sector generally in the US is pretty strong. Existing home sales, as I mentioned, this week were above expectations. House prices are growing at about a pace of about 5.7% annualized in the US at the moment. Mortgage rates are still relatively low, and demand is still there. Of course, the housing market in the US is much more granularized than it is over in this country. You have the London house market and then everything outside. In the US, it's much more granular than that. You have Seattle, San Francisco, a lot of different cities that are doing very, very well, and some not so well. But overall, the market is doing pretty well. As for consumer expectations, part of this is driven by the deep sell-offs we've had in the stock market recently. But if you look at the end part of the line, you can see we still haven't taken out the previous high that we had back in 2005 for the LEIs. So that suggests that the economy still has a ways to go in terms of growth. So continuing with 2016 so far, the sell-off at the start of the year hit global markets, how the US has bounced back to outperform most developed markets. Something I asked our research department to do before I came here, and I think this is from 2011 as of Tuesday when my team produced this chart, is to plot the MSCI Europe, which is, again, sort of a catch-all way of tracking what Europe is doing, and then the S&P 500 above it. And we indexed it back in 2011, so you get a better idea how the two are doing. And you can see there's a very clear divergence in terms of performance. The US, I was rather surprised to find this. I was kind of relieved, actually, to find this as well. It helps my story because it shows how much the US is outperforming Europe. You can see at the end there, we've had the two sell-offs. We had some pretty low lows, but we had higher highs each time. Europe, in fact, had a low, but it still hasn't closed off that high yet, the previous high. I would expect this to continue. The central bank in Europe is going in a different direction, and in most countries, in a different direction to the Fed. And there's a reason for that, because the US economy can handle further rate hikes. We, in fact, believe there'll be 2 rate hikes this year. And that's what I want to talk about just for a second as well, what the central banks are doing. Central bank divergence will continue to contribute to global volatility, as will the differential between where the Fed expects rates to be and where the market expects rates to be. This is it's a nice little cartoon we've been using probably for about 6 months or so with our clients. And it shows Janet Yellen walking away with a punch bowl, which is easy money. And then you've got the ECB, the BOJ, and the PBOC all queuing up to continue to fill up the punch bowl. I think the key thing this points out is the divergence in the different central banks, which, as I said, is occurring because the US is in a strong place economically. Okay, so 2% GDP growth is not great. We're used to well over that, well over 3%, but it's the new normal. I'm sure you've heard that term, the new normal, and it seems to be, in a good place at the moment. I think what's also interesting is a lot of the central banks are being forced to use very unorthodox monetary policy tools, which have diminishing returns in terms of their impact on the underlying economy. We all saw that the Bank of Japan resorted to negative interest rates recently. Part of the reason they did that is because they wanted to drive down what the yen was doing. And lo and behold, what we saw is the opposite of the yen actually strengthening, which obviously isn't where the BOJ wanted it to go. By the way, the Bank of Japan does actually meet this week. And it'll be interesting to see what they say. As I mentioned, the Fed is also due to meet this week. Wednesday is when they conclude their decision. Our expectation is there'll be no rate hike. That's broadly what the whole market is expecting as well. We might get a rate hike in June and then another one later on in the year. That's broadly our expectation. Yeah, it'll be interesting to see how. And by the way, we had all the finance leaders meeting in China recently, and a lot of the people that make decisions on the monetary side, the central bankers, were saying, look, you can't try and create growth in the economy with just monetary policy. You've got monetary policy trying to push the economy up, then you've got fiscal policy almost dragging it down with austerity in some countries. But as well as fiscal and monetary policy, you also need structural reform as well, especially when it comes to labor market reform. I think that's one of the biggest problems that Europe has, is that no one has grasped the nettle of labor market reform. You have a much more flexible labor market in the US. A lot of my colleagues are very happy to travel across the states for jobs, whereas it doesn't really happen in Europe. And the one country that has dealt with labor market reform in Europe is Spain. And while they are starting off a low base, their employment is improving somewhat. Then the other issue, I think this will continue to create volatility this year. Part of the reason we had such a high degree of volatility in February was there were 3 members of the Federal Reserve that came out and held speeches saying, look, we could still raise rates 4 times this year. That was one of the reasons we had the market sell off so much. There were other reasons, China, commodities, all the other things that we're very familiar with. There was some backtracking that had to go on, and the Fed has had to do a degree of backtracking. What we've got here is 3 lines. The blue line at the top is where the Fed expected rates to be back in December 2015. And you can see it's quite a steep line. The expectations by 2018 for rates to be about 3.25%, 3.25%. However, the market, which is the line at the bottom, the estimate has been very, very flat. This was just as of last week. The expectation by 2018 is about 1.25%. So at the last meeting, the Fed actually changed their expectations, especially for this year. They went from 4 rate hikes to 2, which, as I say, is broadly what we expect as well. What was interesting about Janet Yellen's press conference at the last meeting is she used the word overseas and international a number of times, which is a bit frustrating for Fed watchers such as myself, because I thought they were focusing on what's happening in the US. Of course, it does matter what happens overseas, because that impacts what happens in the US, but there seems to be a change in the conversation now from the Fed, that they're more focused internationally than they are domestically. And don't forget, they've almost hit their 2 mandates: low unemployment and price growth of about 2%. A lot of price indicators, whether it's PPI, CPI, or PCE, which is the one that the Fed actually watches, are starting to grow, starting to improve and get up to about 2% or 1.7% or so. But the key thing I wanted to show here really is the difference where the market expects rates to be and where the Fed expects rates to be is still quite wide. And that needs to close to reduce the amount of volatility that we've seen this year. And so for the remainder of the year, still a good opportunity to take part in the US strength. I know not everybody owns US stocks in this room, but there still is the opportunity to take part, we believe. Q1 US GDP, as I mentioned, will be, I think, Wednesday or Thursday. I think it's on Wednesday, 5 minutes, okay. Probably be weak. We've had, historically, Q1 GDP is generally coming weak for the past 4 or 5 years. But this is the first reading, and it generally gets revised up. And we think Q2 could be actually slightly stronger, partially driven by consumer spending. Forward PE, it's about 17 times at the moment. It's slightly above historical median. This is one of the core arguments for the people on the bear side, that the market is overvalued. Well, the market can be overvalued and remain overvalued in a bull market. And by the way, we don't think the bull market is going to turn into a bear market anytime soon. It's a long bull market, as I mentioned, it's the second longest in history, but we think that could continue. It'll continue onwards. US earnings have been weak, but the bar is set very, very low, and it allows expectations. Expectations is what it's about. What is most important. At the moment, we've had about 20% of US companies report earnings. We've had about a 7.4% contraction in earnings. This is the 4th quarter we've had earnings contraction, but we think that could turn around in Q2. Some of the tailwinds, some of the headwinds that we saw from strong dollar or low commodity prices will turn into tailwinds. The dollar is off about 4%, and as I mentioned, oil is up 60% from its February 11 low. And overall, we think the environment for stocks is more positive than negative. Modest growth in the US, low inflation, and the Fed is still dovish, which I think is very, very important. That's my details. Do please ping me an email if I can send you this presentation, if you have any other questions. Schwab have an office over here. My team are over here as well to help in any way we can. And so do let me know how I can help. So we have a couple of minutes for questions. Does anybody have a question I can answer? Yes, this lady here.
Do you have an execution-only platform?
Yes, we do.
And can I hold the money in US dollars rather than...
Yes, absolutely.
And can I invest as a company rather than...
Yes, you can.
Thank you.
Yeah, I can speak to you after we finish here and help you out with that. Yes, sir.
You have various kinds of portfolios. If yours an income portfolio, I presume... that you handle the collection of dividends, the withholding of taxes,
absolutely.
And conversion back into sterling and putting it in your bank account so you can spend it.
Yes, and we give a great rate on the conversion, by the way. We are 3 times better than the banks in terms of the FX rate you get when you take money out of your account. So it's a great service on that side as well.
Hi.
Hello, sir.
Can we invest in an ISA?
No, not through us at the moment.
Okay.
It's just a regular brokerage account.
Okay. How about SIP?
No, not SIPs either. We don't have any UK tax wrappers, whether it's ISAs or SIPs at the moment. It's only something I'm looking at, especially SIPs. We're getting a lot of questions about that. But at the moment, it's just a regular brokerage account.
Thank you.
Only American stocks?
Yes, sir. Just American stocks, just US. Yes, sir.
When you're assessing the US market, shouldn't you really split it in two? There's the energy and commodity bits, which are doing very badly because of the recent prices, and then there's other companies which are doing rather better. When you combine them all in a PE or thing, you tend to get a strange
reading. Yeah, you're right. I mean, as I mentioned, 20% of companies have reported earnings. On an aggregate basis, earnings are down 7.4%, and you're absolutely right. So if you strip out energy and commodity companies, the earnings will be slightly better. I don't have the number to hand, but generally the number has been a lot better over the past 3 previous quarters. But as I mentioned, the tailwinds for these commodities companies are going to start to change really. The headwinds rather of low commodity prices are beginning to turn. Yeah, that might improve. Great. Well, thank you again for your time. I really appreciate you coming to listen to me on a Saturday afternoon. And there's my details if I can help in any way. Thank you.